Well, now to our first conversation. Well, 2022, definitely a tough year for most investors, except you were in stable fiat, select commodities like oil, wheat, but risk assets got hammered this year from equities, Bitcoin, and all of them. Let's talk to Robert now, Motunde, Chief Investment Officer at AfriInvest Asset Management, to tell us more. Great to have you on the program.
Thank you, Ladi, for having me.
And I'm sure your clients must have seen this year as quite a tough one.
Absolutely.
We've seen risk assets, plummet.
Absolutely.
Once we saw Russia invade Ukraine, and we've seen inflation, sky high, at this time. Paint a picture of the global scene, and how it's impacted, the markets down here.
Yeah, thank you. So you see, this year, the biggest event has been that Russian attack of Ukraine. So we always talk about the February 24, which was a Thursday. Call it a Black Thursday, if you can. That was the day that the global macroeconomic dynamics changed for 2022. Don't forget that after the COVID of 2020, and most economies slip into recession, we saw recovery in 2021, right? So that recovery was supposed to continue into 2022. And even though inflation was surfacing at that point in time, because we're seeing some recovery in global oil prices. But what then happened on February 24th, that fateful day, Russia's first attack happened on Ukraine. And of course, what followed was, energy prices soared to a very significant extent. And then we saw the sanctions that came from, Europe and America, any developed country, with the exception of China, of course, India, that have some soft spot for Russia, right? The war is still ongoing, but what then happened was you saw major systemic central banks from US Fed to ECB to Bank of England, all of them pursuing an aggressive tightening course, which has now brought us to where we are today. Because US inflation got as high as 8.3, 8.4%. The last seen was probably, the last time it was at that level was probably 2 decades, before now.
We saw a lot of records broken.
Yeah. So, a lot of records were broken this year. And in addition, we've seen tightening move, got as high as the level that we are now. From as low as 0.25, we're comfortably touching the 4% levels in terms of tightening, And 2023 still promises to be some sort of, tightening, even though there's a slowdown at this point in time. So when we look at the global macroeconomy, which of course informs what happens in the market, that Russian event was a major game changer for the global economy this year. So this year we've seen volatility at its peak. Look at fixed income market. We've seen unprecedented low levels in terms of prices and high levels in terms of yields that were not even seen during the pandemic. In the pandemic, there were a lot of downgrades. The major concern on the pandemic was because there were restrictions, people could not go out, so the demand would be constrained. On the ground of demand being constrained, global oil prices fell significantly. And then what we saw was that, a lot of economies were downgraded by Fitch, Moody, and S&P. And the consequence of that was significant spikes in yields. But I dare say that in 2022, the low levels that were not experienced at the peak of the pandemic in 2020, we saw it this year. Absolutely. It's been an exciting year. Again, volatility has been so high. We've seen periods of ups that were significant, that investors took advantage of. And we've seen low levels. We are not still stable yet, but at least there is light at the end of the tunnel. And that's the investments, what informed our own investment strategy outlook. After we have dimensioned all of the issues, we have looked at the factors that have driven the market to where it is right now. We are now previewing 2023 and saying what are the likelihood of a respite. And we can see it already.
Looking at 2022,
yes.
Do we expect some kind of soft landing?
In 2023.
2022.
So we looked at soft or hard landing into 2023. And when we talk soft, what are the issues we're looking at? So this year, we've seen tightening, aggressive tightening, by the way, which is not just limited to developed economies alone. We've seen it even in emerging and frontier economies. Nigeria is not an exception. Today we're talking about, our own NPR, at above 15% levels, right? Which was never seen since we've moved from MRR, which is minimum discount rate, to monetary policy rate, which is the anchor rate for the economy. This is the first time ever that the rate will be this high. So every economy has faced it, right? So the hard landing or the soft landing for 2023 will be that we are now moving towards a softer levels of headline inflation across major economies. Now, if that happens, you expect that the aggressive tightening will also, moderate. And if aggressive tightening moderates, what that suggests is already that the economies are about to begin to recover in terms of inflation. And we've seen that in the U.S. economy. The last inflation surprise. Market was expecting about 7.7 or so, or 7.9, and then we saw about 7.7, which was, quite exciting for the market, unlike what the market expected. So that's already suggests, and investors actually took advantage of that to trade the market more significantly. And what we saw was an unprecedented low level within the short space as well, which again, we've seen breather. We're expecting another level of, another inflation figure for the US, say in the coming week, this week particularly. So, and once we see that, and we see another surprise level, it's a trigger for another major rally in the market.
And that also, will determine, the next meeting for the Fed.
Absolutely.
Are they going to go 50 or 75 basis points? We know the market is expecting 50.
Yeah.
But it seems there's also a chance of a
75 bips.
Yeah.
Yes. There's a chance of a 75 bips, but we think that where we are now, we think that the Fed should be a bit more assured that the tightening moves is working, and it's working in the sense that we are beginning to see inflation moderate. And if we see another surprise figure this week, it's most certain that a 50 bips is the more likely than a 75 bips as we look at the first Fed meeting in 2023.
And okay, so it's been a tough year, obviously, for 2022 for risk investors. We're going into 2023 now. What can we expect? How do investors, situate their portfolios, to make returns going into 2023? Because it's all about returns at the end of the day.
Absolutely. It's a tough one, right? Yes, but that's why that's the essence of research, which is what we have, taken our time to do. We've looked at the issues from, global commodity prices, geopolitics, trade issues, growth issues, which is a major concern right now, because one of the consequences of this tightening is the slow pace of economic activities that we are beginning to see. And that could carry us into 2023. In fact, there are some projections that suggest that the global economy may even slip into recession. We think that is unlikely, right? Because of course, major banks also, IMF, JP Morgan, Barclays, Citi, these are the major banks that, we tracked, are all also not projecting a recession. Though we also have some exceptions, like the, Bank of America, BNP Paribas, all of those people that are also suggesting that there could be a weaker economic growth in 2023. But if you take all of those out and we look at the portfolio of investors as we go into 2023 across asset classes, you've seen that equities, for example, have also been hit this year with a lot of volatility, that a lot of investors have gotten their fingers burnt. So as we go into 2023, we think that the recovery is in sight. It's in sight because we will expect slower pace of tightening. Now, we may not see a complete reversal, right, of what is happening now. You may not see a Fed reducing rates in 2023, but the best we may likely see will be do nothing. keep the rates at the levels they are, right? And investors are already good with that. They are comfortable with that, knowing that, where you see US 10-year yield, for example, now, it's not even trading at the level of the, benchmark rates, trading below it, right? So that's already suggests that investors think that, Fed may have done enough from a monetary policy angle and looking into 2020. And because that was the major game changer for all asset classes this year. So we think that if there will be, a tempered, aggressive tightening in 2023, then it's positive for the overall economy. And that was what, shaped or formed our own strategy for 2023, when we say investors may have to tilt more towards fixed income. There should be a bias towards fixed income because we think that the yields are peaking and the likelihood of a, gradual reversal is also there for 2023. And, the way the market works, when fixed income yields are dropping, that's when asset prices are rising. So investors who are biased, who have a tilt of their portfolio towards fixed income are likely to benefit. And across board, not just for the US Treasury fixed income securities, but also for sub-Saharan African Eurobond. With the exception of the sovereigns that are going through some fiscal challenges.
Yeah, like Ghana.
Right now, like Ghana, for example. Yes. Nigeria has been lucky. Yeah. It's not like we are any significantly better,
right.
But I think investors still prefer Nigeria, as a sovereign to invest in. And our reserves is the greatest positive that is working for Nigeria at this point in time.
At this point. All right, well, going into 2023, what asset classes do you think are ready to shine, come 2023?
We think that fixed income will take the lead, and that's why we say, we did a model portfolio of where our investors should, shape their portfolio. And we allocated 50% to fixed income across asset classes. So equities is taking about 15% of our allocation because we think that equities will also benefit. The next asset class that is also taking a significant chunk is real estate. We've allocated about 20% to real estate. So you're talking about a 50% to fixed income, a 20% to real estate, a 15% to equities. Then other asset classes, can take the remaining 15% from private equity. Cryptocurrency investors need to be very wary. We have a different view about the valuation. We approach cryptocurrency from a valuation point of view. And we say that, okay, for crypto, the greatest argument has been the use case. Right, and we argue that there is no use case for BTC, for example, today that the USD cannot also do. So, basically, you can see them as substitutes, right? So to that extent, is there a justification for a valuation of, even at the level that is trading now, $18,000 above the USD, and for us, it's an argument that,
There's still the argument
it's a big argument.
Commodity, yes, or currency.
Exactly.
We're still trying to figure out what it is.
It's a big argument,
right.
What I'm saying now, if you have the crypto enthusiasts here right now, we will not end this conversation.
Of course, yeah.
So it's a big argument that we must know. But one thing that is clear is that volatility in that space is real. And then investors who are, sophisticated are the ones that are advised to play in that space right now for cryptocurrency, generally speaking.
Quite a diversified portfolio, and everyone needs to be armed.
Absolutely.
Every investor needs to be armed going into 2023 because the battle against inflation is still there and other economic headwinds. All right, thank you so much. That was Robert Omotunde, the Chief Investment Officer, AfriInvest Management, giving us how to go into 2023. Thank you so much.
Yeah.
All right, we'll take a break now. We're looking at intangible creations of human intellect. That's intellectual property, as the federal government validates the draft National Intellectual Property Policy. That's our next conversation. Just stay with us.